This starts Monday. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, the market is about to go illiquid. I'm going to show you why, with 36 days remaining to the election, why the market is likely to experience a massive correction. And one sector of the market's flashing red, and while investors think this is bullish for stocks, I'll show you why it means the economy is about to head into a recession. Because this is our Sunday show, the show that makes you money, where we like to look at the technicals, momentum, and machine positioning each and every Sunday to help you make more money trading and investing. Now let's head over to X, formerly known as Twitter, with a chart to set everything up. And here we see today's route is right on schedule. In presidential election years, markets peak right around Labor Day, and then a trapdoor all the way into election. Now right here, we're right at October, and I want you to see as we get closer to the election, there's usually a big crash in equities, and this is looking at every year of the market. But when we zoom into election years shown in blue, you can see it's very evident as we get into October, there's usually one decline, and then there's a second one going into the election, putting us in a position with investors completely bullish about stocks and betting big on the outcome. They're loading up on risk, and yet the market's saying we're about to go illiquid. I'm going to show you why on Monday we could see the beginnings of the next big downturn in stocks. Let's turn to Goldman Sachs, where the pain trade lives higher, and they say Saudi Arabia is ready to abandon its unofficial price target of $100 a barrel for crude as it prepares to increase output, and a sign that the kingdom is resigned to a period of lower oil prices. We talk about this one sector that's flashing red flags here, and it's the energy sector. And while many people believe lower energy prices will free up cash flow, that cash flow will then get spent into the economy, lead to higher earnings. What we're seeing is consumers are so far behind the curve right now that any excess money isn't going to likely go out into the discretionary economy. But this is something we warned about, where higher oil prices were not achievable, and now it's going to lead to a flood of oil hitting the markets. We're going to look at deeper into, of course, the oil charts and why this is setting up for a massive recession. But Goldman believes the pain trade of the markets right now is the index sharply higher, led by cyclicals over defensive. As most investors are currently positioned for a market sell-off into the election, and then are bracing for a potential move higher after we know with certainty who the next president of the United States is. Love to know what your opinion is. Who do you think is going to win in November? Weigh in the comments below. But now let's talk about the market here, because according to their prime book, material stocks saw the largest net buying. But check this out. Energy was the most net sold sector in the U.S. prime book last week, driven entirely by short sales as investors bet big on declining energy. And one of the problems is when you see a decline in energy, it actually means there's less demand. The global economy is slowing, and that doesn't bode well for big earnings for companies and higher stock prices. But what is driving all of this bullish sentiment beyond the election? Well, it has everything to do with China's return to Bank of America, and they say Fed cutting in a recession is negative for risk assets, although you wouldn't know it right now with the way everyone's buying. But with Fed cutting with no recession, that's a base case now. That's positive, and investors firmly a view of Fed plus China is sufficient policy now of easing to short circuit any recession risk. We see summer's defensive bull steepening of the yield curve need to flip to autumn cyclical bear steepening to confirm inflation trade back in vogue, which would mean long-term rates need to go higher, but that is not likely the case because we're about to see some illiquidity in the market. And one of the reasons why is, well, buybacks are now 90% in blackout. This starts on Monday, meaning the big companies that are buying their stock back, they cannot do that. We look at machine positioning and what we see over the next week, $35 billion to buy regardless of which direction the market goes. In an up tape, $39 billion. In a down tape, they're even buyers. So we're seeing the machines now go into max exposure in the equity market. We've got some key pivot levels here. Let's take a look at a chart where we see when are the machines likely to sell. And what we see here is here's the current price of the S&P 500. The first trigger point is right down here at about 5,559. So we're ways off from that, but a breach of that orange line would trigger machine selling. A second breach of this midline would send even more selling, and then you don't get the big selling until way down here below 5,000. Not likely to see that in the immediate future for the market, but let's continue on, because let's take a look at our screens here, because the risk we have is we see that the markets are heading into October. There's at least two stages of illiquidity. We're likely to see a decline in stocks. We've got the buyback blackout now in full effect. We've got earnings seasons coming where we're likely to find out that companies did not drive the revenue everyone is betting on. But again, that's going to be ignored, all about China now and Fed rate cuts starving off a recession. Let's see what the charts say as we head over now. Look at the S&P 500. We see momentum is positive. Now, how do we know that? Well, the relative strength index is over 40. That is a solid indicator, as well as the moving average convergence, divergence, or MACD. But what we like to look at is our own Momentum Timer Pro, with aggregates a lot of these technical signals plus a proprietary overlay. We see 13 consecutive daily buy signals in momentum, because these other signals on their own are very noisy. And we look out at the 1 month, 3 month, and 6 month window, and what do we see? Momentum at a mid level, at a max level. It's very stretched here, and that's dangerous. And so you notice we've been out of the market here in our positioning from a trade perspective, because we've been hitting this buyback blackout window. This is seasonally one of the worst periods for the market, particularly going to election, where you see historically we want to reload at that point. We'll let our tools do the job. And we talk about machine positioning. Will we mimic that with what's called our CTA Timer Pro? You see, this is our fast algorithm. This is our slow one. And you notice we're 100% long. We're leading the machines that Goldman say have still more to buy. You want to get an edge on momentum or machine positioning and trade ahead of them. We show you how to do that. There are links in the description below. But let's talk about the upside target. That's right back to all-time highs. The downside target is at 545. Let's see what we're looking at here with SPY. Let's zoom in to the 6 month chart. And one thing we forgot to turn on before I started the show was, of course, our volume profile and our momentum signals. Here we see the RSI and the MACD trending higher. That's pushed stocks up right near their all-time high, where they ran into selling here. What is our downside target? Well, it's the 100-day moving average. Why are we looking at the 100-day? Because it's been an area of support as stocks have climbed up this wall here. But when we zoom out to the weekly, this is the risk here. We see the momentum's been slowing on the weekly chart. You see that here on the RSI, you see it on the MACD, and it's a warning sign that at some point, if momentum continues to slow, remember, what most people don't realize is momentum leads price. So what we're seeing is investors continue to buy into a market where momentum is slowing. There is risk there. But let's talk about now what's going on with the QQQs. But before we do that, how do you make money trading? Well, it's easy to do. Over 2 hours before market opens during the week, we publish our reports and my opinions on the trades you should take. All you have to do, we can't do this for you. You got to put the trade in yourself and put a stop loss on. Then go about your life. You don't have to sit in front of your screen. You don't have to watch your phone all day. And once a week, we give you updated stop loss levels. Whether you update them or not, that's your call. But when you get stopped out, that's where your profit comes in. You get the daily reports. You want to trade against the machines or against momentum? We can do either for you. We give you the tradable signals. I go through every trade and tell you which ones I think are better than others and why. We have backtest data to validate our reports are winners. We give you the stop loss levels. We keep track of all the trades for you every week, and we update the stop loss levels for you each and every Saturday. This is very simple. You can duplicate every one of our trades perfectly, and you get a 30-day free trial. Links in the description below. Now let's take a look at QQQ here. What do we see? Machine positioning is stretched long, which makes perfect sense. Markets are going higher. Machines are there. We led the trend on that. How about momentum? We see 12 consecutive daily buy signals, and we note that momentum isn't as stretched as long as the S&P, but fairly high. We see some mid-level positioning here on momentum on the 1 and 3 month window. Upside target is at 503.52. We hit our target last week. Downside target revised higher. You know, we have no positioning here in the U.S. equity market, and again, that's for good reason due to the risks here, particularly the seasonal risk. We just don't want to take any chances, and there's other opportunities which our subscribers have been taking big advantage of. You've seen some of those during the weekly show. I'll update you on one of those toward the end of the show. But take a look at the NASDAQ. You don't see it breaking out to all-time highs, despite the fact that these tech companies are buying a massive amount of their shares back. Momentum's rising, but price here on the daily is not breaking out to new all-time highs. Let's take a look at the weekly chart. What do you see? Momentum gets overbought once, twice, three times, and now you see it trending down. It's kind of a red flag of where we think tech stocks are going. Remember, momentum leads price here. Our downside target, again, remains just below here, right around the 100-day moving average. That's our next zone of pullback. What we're watching for, a breakdown of that, you'd see the 200-day moving average, which has been a clear level of support. Let's talk about the Russell 2000. Let's see where small caps are going, because the big caps may go higher, but small caps aren't validating. There will be a correction in the big mega tech stocks. Here you see momentum is positive. We have 11 consecutive daily buy signals. We did make money on this trade. We got stopped out. Still think that's the right call here with two potential liquidity events happening next month. We look at Friday's close at 220. Upside target unchanged, downside target revised higher. Notably, machine positioning here remains long, and that's a dangerous sign for the markets because we continue to see machine positioning across multiple asset classes be stretched. But what do you have here? A potential double top forming in IWM. A lot of red candles there, suggesting the next move down here is going to be right around this purple line or around the 50-day moving average. A breakthrough to the downside, which now seems possible, would send it all the way down to this volume profile line. This is where most shares were traded over the last 6 months. This is support. This is the 200-day moving average. When we see momentum here slowing down, all sorts of red flags as we head into a month that's known for illiquidity. How about banking stocks? Many people believe rate cuts are bullish for the banks. Well, it turns out it's not. We have two consecutive daily buy signals on from a momentum perspective. We see machine positioning starting to back off here. Now, remember, we did make money on this trade as well. We made a bunch of money on a lot of these trades, and then we just got out and rotated into different sectors where we see a much higher probability of making money instead of trying to fight, of course, the U.S. equity market. What do we see? One top, two top, maybe three here as it runs right into these two purple lines. What is this? This is called a sell zone. You see price gets in here, and this is where sellers are at. Why is the broad equity market making new highs a red flag in small caps? Because small caps aren't making new highs, not even close to that, suggesting here what we're likely to see with small caps is a move down to this lower supply zone, right where that 100-day moving average or the blue line is. If it finds support, that'll be important. If it doesn't, then you've got the 200-day moving average in play from there. Let's take a look at what is next. We've got, of course, emerging markets. This took off on the back of China. This is massively overbought. We'll show you where this is headed. Upside target 47.15. We hit our previous target, which obviously is a bit of a typo. 9 consecutive daily buy signals. This was one we didn't take risk on, but no one could see China actually getting ready to do all that stimulus. What do we see? Machine positioning, of course, stretched way long on EEM, and this is one where maybe if you look to play the opposite side of the market, that means to the downside, you want to be looking at something like EEM. And what do we see? Upside move here is going to be somewhere around 47. That's way 47.91. So we got a little bit of a ways to go up here, but the real risk is you see sellers emerging here. The more likely play here is this China stimulus is not going to actually be stimulative, and we're right now in overbought territory on the RSI and the MACD. Likely direction we see here from a tactical perspective is a pullback in emerging markets. Let's head on to the bond market where we pick up our trade. Remember, we encourage people to use stop losses, but this is one trade we didn't. And how did we show people to trade this? Let's say you don't and you find yourself upside down, just dollar cost average in, follow the reports. We're up 4.86% on this trade as of Friday's close. We revised our upside target here a little bit and adjusted our downside target. We see 6 consecutive daily sell signals. If you're looking to get back into the bond market, well, maybe you should check out our recent reports over the weekend. We're seeing a pullback here in machine positioning and in momentum on the long bond, but that is going to create opportunity to reload and take a position here as we believe the Fed's likely to cut. What do we see here? Maybe ahead Up here, a left shoulder, possible right shoulder, maybe a little bit of pullback. I've noted to our subscribers, I expect something here, but good chance the Fed is going to cut rates a second time in November. The market may price that in. Support right here, sitting around 97.37 at the 50-day moving average, holding that nicely, looking for another move into the supply zone, see if sellers are here. If they are, well, then that'll put things on ice for a little bit, but once the sellers are worked out, you're looking at a big move right up here into 108. You can see it moves very quickly in between the supply zone. Let's zoom in. You can see it moves rapidly in there. That's going to squeeze out a ton of people that are short the treasury market. Now let's talk about what's going on with the energy market. We've got U.S. oil here. Now, the relative strength index is in positive territory, as is a MACD. That means you got 9 consecutive daily buy signals. Momentum across the 1, 3, and 6 month are at minimum levels, so we don't see very strong momentum play here. But look at this. We're seeing now the machines start to move short here as more short sellers are piling on this trade. Upside target 74, but downside target 67.76. Let's make the case for U.S. oil actually going down, not up. And first, I want to zoom out and show you this 5-year chart. If you want to know what a topping pattern looks like, this is it. And see these 2 purple bars? That's where the buyers of oil are at. They're somewhere right between 63 and about 65.50 a barrel is where they're looking to buy. You break below 63, you see there's some panic moves where buyers came in, but that means recession coming. This is the danger sign that oil starts to tell us about. Downside target here, 67, right here, 67, 67. A breakdown of that puts us right into that supply zone. The question is, with Saudi Arabia looking to pump more oil here and flood the markets, is that going to be bullish for the energy sector? We think not, but something that everybody, perhaps except me, is bullish on, that is gold, and it continues to go higher. Many of you in the comments said, well, I think it's going a whole lot higher. You've got 36 consecutive daily buy signals. You've got machine positioning maxed out. You've got nearly, and this is almost unheard of, where you see on a 1, 3, and 6 month. Now, we're not there on a 6 month where momentum is stretched to the max. When you start to see this at some point, you're going to get a reversal. Many people say, no way, gold is going to the moon. Maybe it is, maybe it isn't. But technically speaking, this thing is getting massively, massively overbought. Let's take a look here. We see that last move did take it into overbought territory. Let's take a look at the weekly chart here and see what we see. And yes, this thing is massively overbought. It pulls back, it's massively overbought. The question is, what could bring gold down? People say nothing. It's only going to the moon. Well, we'll see if you're right. Let's take a look at gold miners, because if gold is going there, well, then you want to hit your cart to the miners. But there's something the miners aren't doing, and that's breaking out to new all-time highs. We see momentum positive here. You got 12 consecutive daily buy signals. The upside target's at 43.60. Downside target 37.62. Again, everything is long here. This is not a surprise. We look at this market and machine positioning momentum, broadly speaking, are very, very long here. Let's take a look at GDX. It's just been climbing here. Every pullback is getting bought. You see a series of higher lows forming and higher highs. This is exactly what you want to be. If you're bullish, you want to see that. Let's zoom out here, because the next target is up here into that 43.60 level is what we're shooting for to chase gold higher. The problem is, why isn't gold miners breaking out? That's the question that we don't have an answer to. Maybe you do, and if you do, wait in the comments. Would love to know what your opinion is, why the miners aren't chasing the metals higher. But one thing that could help gold and the miners is a weaker dollar. That is our base case, with the Fed looking to cut rates. But momentum says there's 20 consecutive daily buy signals on this thing. So momentum remains positive, but how much longer? That's the question. What we see here is machine positioning has started to back off. We believe the dollar's going lower, not because we believe the Fed has any power over the dollar. It's because the market believes the Fed has power over the dollar. And what do we see here? A massive topping pattern. Here is the 2-year volume profile. You see price right underneath it. If you're looking to buy dollars, this isn't the chart setup you want to see, because what you're expecting to find out, people above have been selling dollars, people below buying, and right now the buyers are finding out the sellers are about to overwhelm. This is likely to send the dollar down here as low into the top, maybe the high $26 range. That's where we see it heading. That is risk off move. And of course, a lot of people say it's bullish. not as much as you think. But something it could be bullish for, and this is something we've been telling our subscribers to look at, is agricultural commodities. Here we see soybeans up a whopping 7.22%. This is simple. On August 27th, we told our subscribers buy it open. We even covered it on the show here. All you had to do is buy this and update your stop loss. This is our live level 2230. This is the same number of subscribers get. This is what we told you to buy. We told you ahead of time there's going to be opportunity. This is how easy it is to make money with our reports. Is all you have to do is log in every day and see it. And why did we notice this? Well, when you zoom out, we saw right here it comes down into this level of support. It came down to this level of support. It held it. Our machine positioning changed, momentum changed. We got a paired trade, which is fantastic when both reports confirm. Now we're looking at upside target right here at the 200-day moving average. This is a gold mine, one that is paying off big time for our subscribers. Could be paying off big for you. All you have to do is check out those links in the description below. Sign up for your 30 days free trial. Start trading, start making money. And watch out now. As we head into October, we could see 2 illiquidity events dropping stocks down. As we know, the buyback blackout window is in full effect. And we find out if companies could hit their lofty earnings targets. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.